We spend more money than any country in the world on healthcare. We're sicker than most by far, and there's a reason for it.
First thing I'm going to be asking for is, what's the contract say? What's in the contract?
It's not what you don't know that gets you into trouble. It's what you know for sure that just ain't so.
Are you sick and tired of the high costs and inefficiency plaguing our U.S. healthcare system? Do you feel like you're navigating a maze when dealing with insurance companies, only to end up paying a fortune for basic medical services? Then this Broken Healthcare podcast is for you. So get ready to take control of your healthcare. Here's your host, Ray Kober.
And we're live, ladies and gentlemen. Welcome to Broken Healthcare. My name is Ray Kober. I am your host, and I am joined today by Vince Lewis of UME. Welcome, Vince.
Ray, man, pleasure to be here, man. Thank you for the invitation, and looking forward to our conversation.
Thank you for joining. So, Vince, you and I know each other for a few years now. We travel in the same circles on these trade show circuits and conferences. There's always, I think, in our community, a thirst for education. I'm in this business for over 20 years, and I'm still learning. It's a journey, and you're always attentive and around and present. And finally, I said, I need to have Vince on the show just to talk to the audience about what you do, because your solution and what you represent, stop loss primarily, is something that sits in the background. It's not anything that your everyday folk talk about. And we have all sorts tuning into this. We have brokers wanting to amp up their game. We have everyday people that are just trying to get a handle on what the hell's going on in healthcare. We have CFOs, CEOs, HR directors, management. Before we dive into stop loss and all that, I'm always curious as to what your journey is. We shared that we both have a Catholic school upbringing. I did 16 years, if you count, St. John's and all that. And I know that you have that in your background as well. So we can commiserate about undoing our tie and the top button of our shirt
Right.
as soon as possible. But how did you get here, Vince? What kind of got you from school and finishing up with school to being here today?
Well, it's been a interesting journey, and one that's actually been kind of like I've been in a few different disciplines within insurance, which has kind of got me to this point, right? So upon my graduation from Michigan State, my original plan, because I have a saying that we didn't find insurance, at least for most of us.
Do I say go Trojans when you say Michigan State, or is that the other
Spartans.
Michigan?
Go
Spartans.
Go green. Yeah, not
Go green.
Not Trojans, that's the guys out west. But no, we're the Spartans. But
Right on.
Like I said, I've always had this saying that we didn't find insurance found us. Like most people who get into this field, I don't think, with the exception of a limited few who may have gotten a risk management degree or something like that, usually don't aspire to get in the insurance business, right? So my original plan, I always talk, and this is a great conversation starter, because I usually always ask this question, like, so what was your original plan, right? My original plan was to get into retail. My dad was a tailor. He had always, I'd been around him. He had his own store for a while. He worked at various menswear shops. And so I'd always been exposed to the business. And so I eventually wanted to, I wanted to be a menswear buyer. That was my ultimate goal. So upon graduation, I ended up taking a job, and for a few months when I graduated, and then like through a series of errors, pretty much like on my part, I realized that this wasn't going to be the path I wanted to take, right? And so eventually what ended up happening was I was living in Chicago at the time. I'm originally from Detroit, but I relocated to Chicago. And so I'm sitting in my hotel room, and there was I got a call from a recruiter I was working with. And he was like, hey, I got this opportunity for you. It's with an insurance company. You're going to be in their training program, et cetera, et cetera. And I'm like, okay, great. That's cool. Where we at? We downtown? We out in the burbs? Where we going? Right. And I'm sitting in my apartment, overlooking downtown Chicago. And the recruiter says, well, the job is in Des Moines, Iowa. And I was like, huh? Say that again. But so I ended up interviewing with a company then known as Bankers Life Insurance Company, now known as the Principal Financial Group, which I'm, like I said, I'm dating myself again here. But I interviewed with them, and essentially, when I was offered the job, they basically offered me two paths. The first path they said you could go on is the claims path. The second path you could go on is the underwriting path. And it was basically, it was almost flip a coin, Ray. I was just like, well, I like math. Underwriting seems a little more interesting. No shade on the claims people. But I said, I'm going to go underwriting, right? And so I decided to go into underwriting, and that has led me on this journey. So I started there for probably the first 15 years of my career. And then I got into the sales side after that. And I've been doing sales ever since.
Yeah, that fascinates me, because I believe that everybody in their life has crossroads or a fork in the road that you come to, and you have to go right or you have to go left. You got to make a decision. And so you were thinking of an opportunity really in the fashion industry, right? And you went from that to insurance. And I don't know, fashion seems a lot sexier to me
Yeah,
than
I'd say
insurance.
so, right?
But ultimately, you made that decision, and you stuck with it. You've been in the industry now for many, many years, and it for better or for worse, it's treated you better, I think. But like if you had a crystal ball, and someone would have told you when you were a kid that you'd be in the insurance industry, 20, 30 years later, you'd probably be like, hell no. I know that's what I would say.
No, exactly. And it's been
Right?
38 years. I'm actually getting ready to enter my 39th year in the business. It's hard to
Wow.
believe. So
You
I'm just
look
like,
fantastic. Well, we'll dive into your secrets of health and fitness in a little while. But so before we get there, tell us a little bit about the world of underwriting. What exactly is stop loss? How does it factor into an insurance policy? Is it important? If you could just give us the basics, that would be great.
yeah. So, I mean, short answer, yes, it's definitely important. And especially, we both deal primarily in the world of self-funded insurance, right? So, instead of the insurance company assuming risk for the losses to the plan, for claims to the plan, the company actually assumes all risk for the plan. And as you know, being self-funded can be a bit perilous. I mean, it's like, I use the analogy of walking a tightrope, right? When you're trying to balance everything, you're trying to balance utilization in the plan and trying to control costs. You got to keep the employees happy. You got compliance issues. You got all these things you got to deal with, right? But most importantly, it's the claims. It's about trying to control costs. And so when you look at that, I look at stop loss as kind of being that safety net. So if things don't go right, you've got protection there. So, I mean, stop loss is really just designed it really serves two purposes. It protects the plan against significant individual losses, in addition to protecting the plan from overall claims exposure. Two different products. You got specific, it controls individual losses. You have aggregate stop loss coverage, which covers overall plan exposure. Both intended to be that safety net that will protect the plan should anything go, awry.
And so, an example of a specific, deductible might be $50,000, which means that
Right.
an employer assumes the risk of the first $50,000 for every belly button, every member, every employee, and their dependents that are on that plan.
Right.
And then the aggregate, the overarching coverage, might be $1 million. And that means that an employer is at risk and can spend up to $1 million before the stop loss kicks in and covers them. And do I have that right?
Yeah, that's pretty accurate. I mean, the products are separate, but they're not mutually exclusive. So they can work in tandem, or they can work separately. So, but yes, that's the gist of it.
Is there a scenario where you would have one or not the other? Is it always a matter of the preference of the group, the plan sponsor, in terms of how much, what their risk appetite is? Are there scenarios where it's pretty clear cut and you're like, hey, in this scenario, this is what I recommend. Ultimately, of course, I'm sure it's up to the plan sponsor to make that final determination, meaning the employer or the organization. But how do you kind of do that analysis? Is that even your job?
Well, I mean, we're always in the job of being, consultative to our producer partners, right? So you always want to be able to make suggestions if you're asked, or make recommendations if we're asked in terms of what you think should be done. Usually, the decision to have both coverages or one or the other is really going to be depending on some of the things you already mentioned: risk appetite, you know, exposure, those sorts of things. You have, the bigger you are, generally speaking, the more consistent your claims experience should be. And so you may decide, hey, I don't really need aggregate coverage, but I definitely need specific coverage simply because I want to protect myself against any major losses. And we know ever since the passing of the Affordable Care Act, with the abolishment of removing, having limits to overall plan maximums, that, and what we've seen, the proliferation of claims since then, that, specific coverage is definitely needed. Now, a smaller group, for example, would probably want protection on both sides because claims volatility is a little more significant for smaller groups than there are for larger groups. So the likelihood that they're going to purchase both specific and aggregate coverage would likely be in play there. But again, to your point, it all depends on risk tolerance, what you can afford, and really what's going to make the most sense, overall for the plan.
Yeah, it's really important that an employer understands their exposure always. And I think part of any good benefits advisor is to highlight that, because my contention is if I'm dealing with employers in the mid-market, let's say they have anywhere from, I don't know, 50 to 500 or even 1,000 lives on plan, and they're in a fully insured model, let's say. So everything is kind of taken care of for them. And then they move over and we propose a level funded strategy.
Mm-hmm.
And so they're making a transition from fully insured now to level funded, or, the term that, is kind of ubiquitous is self-funded. It's kind of used interchangeably. Obviously, they do have different meanings. As far as I'm concerned, when it comes to self-insured or self-funded, we're talking about mega groups that really can afford to absorb the risk themselves. When I talk about level funded, I talk about groups that basically have a defined maximum that they will pay in the event that the plan blows up. And if the plan is managed properly, their cost should be less than that. I don't know if you agree with that explanation, but at a high level, that's kind of how I usually lay it out. What would you say?
Yeah, I think level funded plans, technically speaking, are, yes, to your point, designed for usually smaller groups, small up to probably maybe about 200 lives, 250. You'll get a debate one way or the other on those. And it's used usually as a bridge for fully insured groups, like you said, to transition into that self-funded space. A couple characteristics is, one, they don't have a specific deductible. They're really treated as an aggregate only product. There is a fixed cost component and a variable cost component. And those two components, along with all the other costs of the plan, are combined. And so the employer, in the employer's eyes, they get a bill and it's going to look like just like they would see under a fully insured program. But then all the pieces of the pie are carved up, and then the claims portion, the loss fund portion or claims bucket is segregated. And to your point, they pay up to a maximum cost, and that's it. And anything else above that is covered by the carrier, which again is a great transition for it. But to me, it's still all self-funding. It's just a different financing mechanism. That's all.
Right. I have a huge problem with the term self-funding.
Okay.
It drives me crazy. No, it's not with you. It's with the connotation, because let's face it, we are in the business of eating and breathing and living insurance and risk, and we do this all day long. Our clients are not. Our clients are, automobile dealers, they're airlines, they're, manufacturing companies, they're healthcare service providers. They're doing everything that they do. And so when we come in and they're in a fully insured plan and we say the word self-funded to a CFO, what does the CFO hear? It suggests that the model in and of itself is inherently more risky.
Yeah.
And I would argue that done right, done properly, it's the exact opposite, because here's what we can't do. We can't control a member being diagnosed with cancer, God forbid. We can't control a member having a multiple sclerosis diagnosis or any other dread disease.
Right.
We can't control accidents. They happen. They're going to happen in a fully insured plan on that chassis. They're going to happen in a self-funded chassis. What is the difference? The difference is, how can we step in and manage that claim? And we're going to do that prospectively in a self-funded plan done right, meaning we are going to do our best to get that patient, that member, to where the quality is highest. And in healthcare, it's counterintuitive, but the highest quality care is often the lowest cost because of frequency and volume. We have the ability to do those types of things when we manage the supply chain of healthcare in a self-funded, level-funded plan, whereas we don't have any such control in a fully insured plan. And if the risk is addressed on the front end, meaning that the plan was designed properly for the benefit of the client, their risk exposure technically should be as good as it was in a fully insured model. Would you agree with that?
Yeah, I mean, that's the beauty of it, right? I mean, that's what self-funding does. And I'll ask you a question, but let me finish this first. But that's the beauty of it, right? You've got the flexibility to make whatever decisions you want to make in accordance to the plan, and working with an astute advisor, right? Like yourself and others out there. They're going to make suggestions. They're not going to just give you just kind of the cookie cutter stuff, right? You're going to come with innovative, thoughtful solutions that will be able to drive costs down. I mean, and when you think of a self-funded plan, I mean, out of every dollar, only there's probably 5% of your self-funded costs are going to be on the fixed side, right? Stop loss, admin fees, et cetera, et cetera. The rest are claims. So don't focus on the 5%, this little sliver of pie. Focus on the rest of it, because that's where you're going to have the most impact. And if you put in the right solutions, then you're going to see impact year after year after year after year. And it's been proven. It's been proven. For those who tend to go the more traditional routes, and some folks still believe that they can't impact costs, but in fact, we know, you and I both know, that's entirely possible. Now, my question, you said you don't like the term self-funding. So what would you call it?
I wish I had a better answer for you, but I would call it self-funded, but I would always make, like, as soon as those words come out of my mouth, I immediately define what that means, because that's the term we're stuck with. So I can't remarket what's already out there.
Right.
That's what it is, right?
Yeah.
But it's super, super, super important. And typically I will ask a question. Have you thought of self-funding? And when I say self-funding, what comes to mind? What do you think? And like, oh, that's too risky.
Yeah.
And so, listen, I'm not here to call anybody stupid, but that is a ridiculous thing to say. So I would have to unpack that more and say, well, why do you believe that it's more risky? Because the way that I look at it, Vince, is if I sell my client a fully insured plan, and I do have clients that are fully insured, 100%. I've gone through the analysis with them. I tell them the good, the bad, and the ugly, as I always do. I'm in the business of meeting my clients where they are. So I'm not here to dictate to them, what they do or what their comfort level should be. But if I, look at a fully insured plan versus a self-funded plan, the obvious question is, what mechanism do I have to control costs? To your point, claims is 80 to 85% of the spend. That's where you have to focus your energy. It can't be on the 15 to 20% of
20.
admin, including,
Right.
stop loss. That's not going to get you home. That's not going to get you where you want to be. And in a fully insured plan, you have no mechanism to control your claims expense. People are going to go to wherever their providers are in network, and it's like a blank credit card. You would never give your employee a blank credit card and say, "Yeah,
Right.
you want a computer? Go ahead, go out and get the best Mac you can find." It
Right.
doesn't work that way, right?
Right.
But yet, every year, employees get a magic credit card with typically a big insurance carrier logo on it, and it's like, hey, there's no limit. Just go and have at it. But I don't think business leaders think about it that way. I think that they think about, we want to provide the best insurance coverage for our employees. They are hopefully the better ones
Right.
who really care about their employees. Say they are the life's blood of our organization. We want them to have the best, highest level care that there is, spare no expense. But there are two sides to it. There's the cost, of course, and there's also the quality. And you have no control of either mechanism in a fully insured plan, whereas you most definitely do in a self-funded or level-funded plan. And so I appreciate what you do. How does, in your opinion, let's switch gears and say you're not leading the sales organization at UME, but you're newly minted as a CFO in an organization, and you have 1,000 employees, and your spend is $10 million a year, and you come in and you say, all right, what are you doing? And you learn that there's a fully insured plan there. Where do you go from there? How would you get started on righting that ship? Or would you say, hey, we're doing just fine?
Well, okay, you're making me king for a day. That's cool. I think
I'm making you the master of coin.
the master of coin. There you go. Your Game of Thrones. All right, I like that. I like that.
You're the master of coin.
There you go.
So I guess my question really is, in terms of looking at it, assuming, of course, based on what we just talked about, you're switching out of fully insured and you go self-funded. Where does your solution come in? And at the CFO level, are you getting involved there? Are you relying on a benefits advisor to get involved there? And supposing that that's the case, because I believe that that's going to be the way the engagement happens in the real world, what would you look for as you sit down with your benefits advisor? What types of questions would you ask that you think are good, prudent, intelligent questions about what they're proposing? And you could give us a hypothetical of what might be a proposal in something like that.
So I think that if I'm a CEO, CFO in an organization, and I'm talking to my advisor about, my overall plan, and then perhaps in particular how stop loss fits in the middle of that or within that equation, first thing I'm going to be asking for is, what's the contract say? What's in the contract? What provisions are in the contract? What are the gotchas? What are the exclusions? What are the limitations? What, is there, if you're comparing me to if there are other proposals that you want me to see, how does one compare to the other? I did an interview with Adam Russo, my prior job of the FIA group. And I asked him kind of a similar question. What's the biggest issue you see in stop loss?
Yeah.
And number one thing he said is people don't read the contract. People do not read the contract. And so advisors don't read contracts either, because usually the biggest point of contention in any stop loss, you can talk to whatever stop loss company you want to, provider you want to. Biggest question comes up usually is going to be a claim issue. And it's usually because the contract was not read and not reviewed to know, hey, contract says this.
Yep.
Oh, I didn't know that, right? And then the employer doesn't know it, and then it just rolls downhill from there. So I think the first thing, again, is just making sure you know all the provisions of the contract. If you're showing comparative offers, what those look like, right? How do they differ? Because at the end of the day, Ray, you get what you pay for.
Yeah.
And people don't realize that. People want to try to boil down stop loss, which is enough. It's kind of it's an issue with me, and I'm sure with others in our industry. People want to break down stop loss to being somewhat of a commoditized product, that it's just all about price and nothing else.
Yeah.
And that could be the furthest thing from the truth. Because again, you get what you pay for. And you might see this, this bright, shiny, cheap, offer on one side, but you don't know what lies beneath that. Yep. So it's good to know at least know what you're buying, right? And if you go in with your eyes wide open, awesome. But know what you're buying.
No, and that's a great point. In any insurance contract, my eyes always go straight to what's not covered, right? Look at the exclusions, right? Because that is where the risk lies. That's, if it's not covered by the policy, then what does that mean? Well, it means that you're exposed there, right? So that's important. Are there any other provisions other than exclusions that kind of are on your hit list of, hey, what does this say? What does that say?
I think the probably the main thing is making sure you have a policy that mirrors your plan, right? That there's a plan mirroring provision in the stop loss policy, because at least that way, if there's a discrepancy between the plan and the policy, the plan's going to rule because you've got that provision in there. Most stop loss contracts, have most of the same general exclusions and limitations, but that plan mirroring provision is important because it determines not only what's covered and not covered, but eligibility and things of that nature, so that there isn't some sort of end up being big surprise, should a claim be denied or something along those lines. I think a couple other things, even non-contractually, but just making sure you're dealing with a carrier that's highly financially rated, knowing and understanding as an advisor in being able to dispense wisdom to the CEO or CFO, knowing like that carrier's reputation for paying claims, understanding how disputes are handled, understanding and having, more importantly, again, going back to this whole commodity issue, having a relationship with whoever you're working with there. Because a lot of times relationship can cover a lot of different issues, and having a book of business and being on good terms. So that way, when problems do arise, and they will arise, that the relationship can get you over those hurdles. In many instances, folks want to work, with this carrier and that carrier, and then they end up having a problem. And, it's like, well, wait a minute, we only got one case with you. Like, how am I supposed to, I have no leverage to get anything done. I mean, I'm just keeping it real. Yeah. I don't have any leverage to get anything done here. So it's always, to me, it's always going to be a give and take.
Right.
And I'm going to have pebbles in my bucket. You're going to have pebbles in your bucket, and we're going to take from each other from time to time. But eventually, it's all going to level out.
Right. Yeah. No, those are all key things to think about, and particularly with respect to any insurer's financial stability ratings. You can't just forget about that stuff. That stuff is important.
Right.
And, understanding, so you're an MGU, do I have that right?
Correct.
So
Or managing general underwriter.
Explain what a managing general underwriter is. How is that different than other stop loss solutions that are available in the marketplace?
So managing general underwriters, or MGUs as we're called, there are, take up a large portion of the industry, just like as, say, direct writing carriers do, your Sun Lifes, your Tokyo Marine HCCs, your Symetras, et cetera, et cetera. MGUs are full service in most cases, not all, but in most cases are stop loss providers that provide basically full array of services as it relates to underwriting. They handle premium, they pay claims, administer policies, et cetera. Again, not all, we do at UME, but not all, but handle most of the general functions than any other stop loss carrier or provider would do. The big distinction between MGUs and direct writers is usually in the risk taking area in terms of on the policies that they underwrite. MGUs, usually they pay a fee to a carrier for the right to use to issue policies under their name or using their paper, as they say in the industry. Mm-hmm. And thus they'll issue those policies, but most MGUs take little risk or a smaller portion of the risk or no risk, whereas direct writers take the lion's share or all of the risk. And that's usually the biggest distinction. No one's created equal, but at the same time, they all provide service. Direct writers, obviously, in many respects, a lot more name recognition, those sorts of things. They have a direct line to authority to get things done. That's, in terms of get underwriting and claims decisions, that sort of thing. MGUs tend to be a lot more nimble, be able to get things done quicker, are able to tend to be more relational, tend to be a little bit more insular in terms of their client base. So they're not like, in some respects, dare I say, boutique-like in their approach, because some have like just a specific area of business they want to go after, whether it's level funded business or whether it's, other types of business that they like to pursue. But those are kind of, I would say, the main distinctions between the two. But yeah, it's really all about the risk sharing aspect.
The Tokyo Marines of the world, the Sun Lifes, do they reinsure a portion of their risk as well, or are they keeping everything under one roof?
I mean, I don't know the particulars, but yeah. I would venture to say they're probably reinsuring most, if not all.
Yeah, I'm under the impression that even the giants, don't take all the risk, even though right. quote unquote they say they are. They're even offloading a portion of the risk. It all boils down to being a big casino, right? There's somebody figuring out the math and how much risk everyone is comfortable with.
Well, it's interesting because I don't know if you read any of the recent reports that came out. I think some of the major carriers have come out with kind of their reports talking about how claims are proliferating through the industry in terms of, high dollar claims, $1 million plus claims. You're starting to see the impact of that now. You're starting to see, especially ever since COVID, how that's kind of accelerated. Now you're starting to see the whole emergence of gene therapy claims. I just read in the New York Times yesterday, they just administered that sickle cell anemia drug to the first patient. I think ended up being like $3 million or something like that. Yeah. So, I mean, this is happening. I mean, even in my book of business now, I'm starting to see gene therapy claims you're starting to see, or at least the potential for a gene therapy event to happen. And so now, it's just going to continue to escalate, man. It's going to get wild out here. So it's already this is going to get wild.
Yeah. I don't know if you know the answer to this, but what happens in a fully insured plan when someone needs a $3 million gene therapy intervention? Is it just automatically covered, or is it case by case, or how does it work? And then if if the provision of your contract is you have that plan mirroring provision, and you came from a fully insured plan that, let's say, their language authorized it, then that's something that you have to take into account. And then is your stop loss premium through the roof? Or I don't know if you could speak to that, but I think it's an interesting question. If you're in a fully insured plan, does that mean the sky is the limit and no holds barred?
Yeah, generally speaking, I'm not really sure how the fully insured market is treating gene therapy. I mean, in this particular instance, the claimant I mentioned just a minute ago that was in the New York Times article, their insurance covered it. But I don't know if that's applicable to all plans, or whether all fully insured plans would do it, right? To your point, in a self-funded scenario, if the plan chooses to cover gene therapy, it should be fine as long as the whatever therapy that's being recommended is FDA approved.
Right.
There shouldn't be an issue there. But you got a lot of plans that aren't covering it. They're just saying we're not going to cover it at all. So,
how do you guys deal with that? Do you have a separate fee that you charge? Do you make it an elective, or is that something that you're, I don't know. Do you have a protocol for how to deal with it?
Yeah. So, I mean, I know you're starting to see products out there. I know Amwins has a gene therapy rider product that's out there now that they're using. I'm not aware of any others in the market right now. You can maybe work with someone that offers, like we work with a company that offers a center of excellence for gene therapy. So at least if we know there's one coming down the road, we can utilize them to try and get, some reduction in costs, get case rates, et cetera, to offset that.
Yeah.
But we don't charge an extra, we're not charging additional premium to do anything along those lines. Our stance is usually just, hey, if it's covered,
right,
under the plan, and as long as it's FDA approved, we will honor it.
Yep. It's crazy though. There are a number of drugs out there. I was talking to Renzo Luzzati. I had him on the podcast, and he was talking about a drug called Strinziq, and it's like, a $2 million drug.
Yeah.
So,
Yeah.
It's just crazy. So, when you think about that and you say, okay, well, the national average premium for a group, per employee per year is approaching $17,000. Well, 17,000 versus 2 million, that seems like a bargain, right? But the reality is these drugs are starting to proliferate. And if they do, and I don't care if it's a fully insured plan that's covering it or a level funded, self-funded plan that's covering it, there's only, one possible outcome, and that is premiums are going to accelerate.
Yep.
And it's just a mind blower that stuff is out there. So You gave us a lot of good stuff. I think particularly the piece of advice of reading a contract, especially if you think about your day-to-day business operations and you are in leadership listening to this, you probably have attorneys in-house or on retainer that you're sending contracts to look at all the time,
Right.
Real estate deals and transactional deals and contracts, et cetera. Yet you're not sending your health care contracts, the PBM contract, the stop loss contract to be reviewed. You might consider that as a best practice, especially if this expense is into the millions of dollars per year, because you want to know that you're covering your ass. At the end of the day, that's what it's all about.
Well, not only that, right? I mean, look at what's been going on in our industry, man, with all the, heightened awareness around fiduciary responsibility.
Yeah.
I mean, the Johnson & Johnson lawsuit, among other things. If I'm a CFO or CEO of a company these days, man, I'm going to make sure I do everything I can to make sure my I's are dotted and my T's are crossed, because you just don't know. I mean, something could happen, someone either get denied coverage or realize they're paying these exorbitant costs for procedures that they shouldn't be paying for, or getting a claim denied. It's just all kinds of, there are all lot of pitfalls that you can fall into from failure to just doing the simple things. So,
it's not too hard to do.
Right.
We have folks that review contracts, and most qualified benefits advisors have folks that review contracts. I know that as a newly minted Health Rosetta advisor, our team has access now to a whole litany of things, checklists and stuff that really kind of dissects and gets into the minutia of details. And that stuff, becomes more and more important as the spend goes up and as the risk goes up and as the, frankly, the fiduciary obligations, to your point, under CAA are more in the spotlight now than ever. So this is all really important stuff. But it brings me kind of back to square one in saying that if you do all of your work and if you do all of your diligence, then a level funded or a self-funded plan that has gone through the ringer of checking all of these boxes is no less risky than a fully insured plan. It's just a matter of doing your diligence, and the devil is in the details. If you're just kind of being carefree, saying, yeah, sure, we'll do it, that's when you get into trouble. It's what is the Mark Twain quote that I love so much? It's not what you don't know that gets you into trouble. It's what you know for sure that just ain't so. Right? So that's it, man. It's just you gotta do your homework. You gotta partner with the right people. You have to ask intelligent questions. But if you do those things, I have groups that are spending in the ballpark of $2 million a year. And if I show them a 10-year projection, they're saving $18 million a year over 10 years.
Mhm.
And if they're at a 10% gross margin, that's $180 million in sales that they would have to generate to realize a bottom line profit of $18 million. This is real money.
Right.
And how can you enrich the lives of your employees and pay it back? And then, if you get me started down the path of what's going on with, our food supply and the fact that, we're being poisoned, and that is feeding the medical industry, causing all of these high cost drugs to crop up and fueling this $4.5 trillion spend. That's a conversation for
Oh,
for another day.
You must have. Did you watch the Joe Rogan podcast the other day? Yeah,
I did.
last week. Yeah, that was eye opening.
I'm a fan. So that was with Casey and Callie Memes.
Right.
And for those of you that didn't catch it, go out there and catch it. And actually, I'm in the process of reading. I'll give her a plug. Good Energy. So this is Casey Memes, MD. It's a mind blower, man. Just to give you the cliff notes, she's a Stanford trained, physician that busted her ass and got the best grades and did everything right and went through residency and, broke the tape in the finish line. And she put her scalpel down and walked away from the whole industry because from the medical profession, well, I don't know if she's probably technically still a doctor, but she basically threw away her career after all of that because it became abundantly. Her mom was diagnosed with pancreatic cancer. And as she kind of pulled back the layers, knowing what she knows about medicine, her eyes became open to the fact that, I hate to say it, but the system is a racket. And her mom was, she came to her disease and her illness in a matter of 13 days from diagnosis. She was gone. And, they wanted to bring her mom in and treat her with all these, drugs and chemotherapy and this and that. And they made a decision to refuse. And so she then had the ability to spend, along with her family members, some meaningful quality time with her mom before she passed. But she mentions in the book that she's got, a friend in oncology, and the friend in oncology says to her, whether you need it or not, if you walk through our doors, you're going to get surgery.
Yeah.
And it's just like,
Yeah.
holy, like, really? So I'm reading this book and, knowing what I know and doing what I do, I'm just like,
Right.
And
Yeah.
so the other piece of this, people, is, we're talking about the dollars and cents, the risk side, the cover your ass side, all very important. But I think we're going to start to see a trend in this country, not company, country. I hope we see it, company to company, where people are focused on the quality of their healthcare. And when you focus on the quality, then costs will absolutely fall in line. But we have to break away from the racket and the game that is big insurance, big pharma, and big healthcare systems. And listen, again, I've said it before, I'll say it again. This is not an indictment on physicians and surgeons and nurses and nurse practitioners and RNs and all of the, the CNAs out there, the
Right.
people that do the work that none of us want to do.
Right.
It is, I put those folks on a pedestal and I hold them in high regard. But I think by and large, most of them are not even aware of what's going on. They're focused on healing people and helping people. It just so happens that they're they're a cog in the wheel of this system that has us spending 20 cents of every dollar on healthcare. And I do think we're at a tipping point. And I think, shout out to Casey and Callie Means for leading the charge, along with whatever you think of Robert F. Kennedy Jr., who was on the panel in front of the Senate committee, Dr. Marty McCary, all of the amazing people that testified in a Senate committee hearing. We are at a tipping point, and it's more than dollars and cents. We all got to get on board and pull together, because this is the quality of our lives. It's, our generation, Vince, I think a lot of the damage may have been done, But I do think that there's still an opportunity for folks in our generation to start making better choices that could improve the quality of our lives. But down the road, as time goes on, if all of a sudden you go out and you're eating fruits and vegetables and you think everything is healthy and wonderful, but all of that shit is being sprayed with toxic chemicals unless you're buying organic.
Yep.
Well, then you could be doing more harm than good. And I think that's the boat that, so many of our fellow Americans are in right now. And it just look at the numbers, man. It's like the numbers don't lie. Math does not lie. We spend more money than any country in the world on healthcare. We're sicker than most by far. And there's a reason for it. And so we got to open our eyes and wake up. And sorry, I went off on a rant.
No, that's okay, man. I mean,
yeah,
the way I'm like this too. It's like, I think right now we are at the precipice of something big happening. Too much has gone on. I mean, you start layering on all the things you just talked about. I think people in general are going to want to be more educated about health. They're going to want to find out more about their health, how they can be healthier. Our generation, we're kind of kind of on the fence, but I think the generations, like I got adult kids, their generation,
Me
that's
too.
a whole other story.
Yeah.
So I think they're going to be looking at this a lot differently than how we look at it, and not because we've been so conditioned to believe that the doctor's always right. We've been conditioned to believe that.
Yeah.
And they are in some cases, but like how's the phrase go? Trust but verify. You know what I'm saying?
Absolutely.
It's okay to do your own homework. It's okay to get a second opinion. It's okay to get other points of view, and then have all the tools, just like anything else. Like you hear the whole analogy, like you wouldn't buy a car, just buy it just without checking other things out, or whatever. Right. You would compare, you would do your research, and then you make an educated decision. And I think that's what we've put physicians in this position of trust, right or wrong.
Yeah.
And we have to deprogram ourselves from that type of mentality so that we can, again, make educated decisions for ourselves. And, knowledge is power, right? So the more we know and the more information we can get on some of the other things that are going on out there in our world, then we can go in and then say, okay, now I can look at some other type of procedure, or look at some other type of drug, or look at some whatever treatment. Yeah. And hopefully that'll, again, help drive down the cost of healthcare, help drive, and hopefully they would pass on that whatever gain through or whatever that's being received by an employer, they can pass it on to employees, hopefully.
Yeah. There are many things that we could do. I think it starts though with what you mentioned, and that's, knowledge is power. You got to educate yourself. And when you do, though, when you start peeling back the layers, you can't help but get pissed off, because we are being gamed, and it really is criminal, because I know that there are, many of our politicians are dirty and they're getting paid. And look, we're human beings, right? It's very hard to resist the temptation of being kind of wined and dined and schmoozed, and someone, wants to stick a fat envelope in your pocket for something it's easy for you to do with like the stroke of a pen without thinking about the consequences of it. But when you start looking at the numbers and you compare the U.S. to other countries, why are rates of autism so high?
Right.
The rate of autism now in California is 1 in 22 children born are going to have autism.
Yeah,
that's insane.
Yeah, that's
I'm sorry, we don't need a double-blind study to tell us what the fuck is wrong there, right?
Right.
We don't. Like, hey, there is something going on. We know what it is. Let's wake up. Let's unite as a people. Let's stop poisoning the food supply. A good start would be to just mirror what they're doing in Europe. In Europe, they allow 400 different ingredients, chemicals to be part of their food supply. In the U.S., it's over 10,000.
Yeah.
And it's self-regulating, and it's being rubber stamped by the FDA and the CDC and the NIH and all these organizations. Their biggest funding and contributions are coming from pharma and insurance.
Yep.
It's like, hey man, I don't need a study. And here's the other thing. Like all of these ads that we see on TV, all of this nonsense with drug commercial after drug commercial, it's not so much about persuading the patient to go into their doctor's office and ask for that medication, which is totally fucking ass backwards. It's about power and control. Now they have influence over the media. Vince, I was a communications major. When I was studying back in the day, they talked about the rule of sevens and the rule of 12s. And it was the whole idea that the government did not want any one conglomerate to have power over mass media.
Right.
And they recognized back then that if you owned newspapers and you owned radio stations and you owned television networks and stations, that would mean that you have undue power and influence. We need to go back and take a look at that, because the media that we're being fed, if you're a Democrat, you're being fed a bunch of horseshit. If you're a Republican, you're being fed a bunch of horseshit. You don't know what to believe anymore.
Right.
And when the message is being spun by these entities that are then the majority of the funding for these federal agencies that are there to safeguard and protect you and I and our families and our fellow Americans, if that money is coming from pharma and insurance, man,
right,
we got a problem.
Yeah, totally.
So look, I hope this message gets out. I hope that the audience likes and subscribes and shares this, and pick up good energy. Read this book. If you have not seen the Senate committee hearing, it's 4 hours, but we'll link in the description below. Go and check it out. And look, you could be a naysayer, and you could. There are paid puppeteers that are part of this problem, that are propagated by the folks that want you to believe that, you know what, the water's just fine. Well,
Right.
they're cranking up the heat on our frog asses, baby. And the water is not fine. Like,
Right.
it's time for change. We got off topic a little bit, but is there anything else that you wanted to say about your organization, about what you have going on?
No, I appreciate it, Ray. And this has been awesome, man. I've really enjoyed this conversation. It's not like any other type of podcast I've been on, at least related to the topics of insurance and healthcare and that sort of thing. So this has been a really great conversation. Just a little bit about Underwriting Management Experts, UME. We're full service MGU as a stop loss provider out there. Been in business since 2015. We have multiple stop loss solutions or self-funded solutions available. We cover traditional and level funded stop loss. We have a product called Max Advantage, which covers that. We do captives. We're launching our own captive product here early next year called Sapient Health, which we feel is going to be very groundbreaking. We do MEC plans. We also offer student medical plans. So a lot of different products in the portfolio. Our value proposition is about creating disruption through independence, innovation, and flexibility. Multiple carriers that we underwrite for. If you want to get a hold of me for anything, or would like to get more information about us or about stop loss or anything in general related to this, what we've been talking about, you can reach out to me. I'm available. I'm on LinkedIn under Vincent Lewis, not Vince, because my mother, I don't know why I got to change that, because the only person that calls me Vincent is my mother. But I'm under Vincent Lewis on LinkedIn, or you can email me direct at V as in Vince Lewis, BWIS, not LOUIS, but LEWIS at umexperts.com.
Awesome. That's great stuff, Vince. Really appreciate you. And yeah, for our audience, at the end of the day, if you're in the market for Vince's services, what I always look at is, what's most important to me is, do I know this person? If a problem arises, and we know there are going to be problems, can I pick up the phone, and are they going to help me solve this problem? Are they going to be invested in getting it done? And I think I know you well enough, Vince, to know that you are that guy. So definitely check him out, give him a shot. And thank you for tuning in, folks. Again, like and subscribe. That's always helpful. But more than anything, we're in this together, and we don't have to take this shit anymore. Peace.
So that's it for today's episode of Broken Healthcare. Head on over to iTunes or wherever you listen and subscribe to the show. And join us on the next episode.